Have we seen the normal August trading lull that we usually see during the dog days of summer? Well, our chief equity strategist and economist, John Blank, has been keeping his eye on that, and he's here now with the answer. John, until last Friday, we've been seeing, I think, lower daily trading volumes causing higher volatility that would indicate that many traders were on summer vacation, and overall there was an August trading lull. Is that right?
Terry, I'm looking at the performance of the S&P 500 over the last month. We're speaking on August 28th. The S&P is up 2.27%. Over the last 3 months, it's up 9.66%. And over the last year, it's up 15.94%, which is totally in line with my estimates, in my S allocation report for the annual return. So not only was it a strong August, but it really just brought the S&P's 500 annual return back to where it was going to be before the Liberation Day tariff news.
So it shaped up to be a strong August, no August lull.
Correct. I mean, 2.27% return is on an annualized basis is 25%, Terry.
All right. So back on August the 4th, published data showed the Dow 30 index was the only benchmark that had yet to hit a new peak after April's tariff panic. But that all changed last Friday when Fed Chairman Powell signaled that the Fed could begin easing monetary policy next month in September. And he said that at his annual Jackson Hole speech. That sent the Dow to an all time high. In fact, there was a pretty broad based stock rally that went with that as well. So I guess he gave the market exactly what it wanted to hear.
Well, the market wants liquidity, particularly small caps, Terry. The part of the Dow that went up with it was the small caps. The Dow and the Russell 2000 were the ones that were lagging and not hitting record highs, and both got their mojo together on the idea that liquidity is going to come from the Fed in September. Um, in my opinion, Terry, this is really jumping the gun. We've got a September 16th, 17th FOMC meeting, and there's non-farm payrolls and CPI and core PCE reports all the way through September that will inform the Fed during that meeting. So anything that people think now about what Fed Chair Powell said is it's not irrelevant, but it's going to be updated. And the Fed always likes to be current.
September, is typically not a good month for stocks. Might this late summer rally extend into next month, aided by a rate cut?
Terry, I think after Labor Day, um, we're going to start to see more and more of the depleted inventories from the big pull through in the first quarter through the second quarter dissipate. And in a very incremental but broad based way, I think we're going to see the tariff effects play out more and more strongly across the U.S. economy. So, given the seasonality of September and October is weak, given the 25 forward PE on 2025 earnings, and given this giant headwind of 18.6% tariffs across the U.S. economy, I am more bearish than most people about things.
So am I hearing that there's still some uncertainty affecting the market?
Massive, epic uncertainty, Terry, and it's not going to go away uh, until Christmas season on the tariff uncertainty. And once that uncertainty resolves, it's not necessarily the case that uncertainty resolves in a positive fashion. People can find out there is actually a worst case scenario playing out in people's minds, and that's literally been off the table. I looked yesterday, on Polymarket odds of recession in 2025. They were 65% back in May. They're at 11% now, which is absurd, Terry. We're not in a situation where there's no jobs being created by the U.S. economy. We know this, and there's a 10% chance of recession, which is super, super low.
So is all this uncertainty the reason that stock market bulls might have to be cautious going into the fall?
Terry, the problem with momentum trading is when is momentum trading over? I mean, the trades work to stay long, aggressive high beta stocks, and it sucked enough people in over the last 3 months on the breadth story out of the China trade reversal and all the rest. But you got to ask yourself: every day turns into another day, and 5 days make a week, and 5 days after 4 weeks make a month. And certainly, sooner or later, a market that's at 25 PE when it started this rally at a 2021 PE is not the same market. It's a stretched market. It's a valuation driven market. And, out there in the world, when does something happen in a massive way to shift the dynamic to selling instead of buying? I don't know, but that's the answer.
Along those lines, tech stocks sold off a bit recently, so are investors rotating out of the riskier stocks into previously lagging sectors because they're worried about the staying power of AI?
There is some of that, Terry, but not as much as you think. I mean, today we're seeing a pretty much a flat market, just listless market running into the Labor Day weekend after the big Nvidia report. And this is, again, this is really got to wonder if the momentum traders reverse here in September, and everything you're seeing here is this listlessness until people get back to their trading desks and then make their changes.
It's going to be difficult to pick winners out of that AI universe going forward.
Yes, because we got a narrative-driven market, Terry, that doesn't care about profits, and until it does, and we don't have a lot of, MIT study said 95% of these AI things have not generated profits, and so gets back to what happened to the biomedical stocks after CRISPR and other areas where people get super excited about the potential for a technology, and they really don't understand where their business models are going to be sustainable, profitable, and generate the kind of growth that people are selling to them.
Against this backdrop, John, does a stronger than expected Q2 earnings season, a bullish outlook for earnings into next year to go along with that, suggest to you that the S&P 500 has more room to run higher, at least for the rest of this year?
I think there's no reason to carry on the discussion on Q2 when we're well close to wrapping up Q3, and everybody knows that the second half of 2025 is going to be very different than the first half, and frankly, the first half of 2026 is really where we should be talking, and that's where like the conference board leading indicators rolled over in May. They roll over on a 7-month forward look, and that is basically 2026, early 2026, and so we should be talking about early 2026 now.
All right, two major U.S. financial services stocks and one major French industrial have been on your radar lately: Charles Schwab, Citigroup, and Schneider Electric.
Yep, Charles Schwab, Terry, I got at $97 a share with a target price of 111. The forward PE here is 21, which is not too out of line for a financial, and it's been on a nice roll. It's getting up to the highs in 2022, but I could see this stock actually, adding another $10 a share. I don't think there's a lot left in this stock, but that gives it a nice return for a little bit stretch of time. Citigroup, this chart looks extremely overstretched. We were down at $60 a share in the Liberation Day tariff debacle. Now it's at 97, Terry. That's like a 60% move in 4 months. I have a hard time when any stock moves like a massive financial 60% in 4 months. I'm a seller of Citigroup. Schneider Electric, Terry, is really interesting. This one is it's a CAC 40, which means a major industrial name in France. It's a 190-year-old company. Ticker is SBGSY, and it is getting some love because it is, after some acquisitions during the COVID period, one of the companies that is building these data centers, particularly in Europe. And so if you like the data center story and you don't want to just play the same names, take a look at Schneider Electric.
All right, our chief equity strategist and economist, John Blank, on stocks and the August trading lull that never happened. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.